You can almost hear Ethel Merman belting out, "Everything's coming up roses." That's how good the financial and economic situation is. In the first week of 2017, the Standard & Poor's Index of America's largest 500 publicly offered companies broke its all-time high. With everything coming up roses in the economy, investors have to wonder if stocks are becoming a gamble. So, before showing you why the future is looking so bright you have to wear shades, let's put things in perspective. It's easy to be so caught up living day to day that you lose sight of how unpredictable life can be, and that no one knows what the future holds. Life is fraught with risks to your health, to your livelihood, and to your loved ones. And then there are events in this world that no one would ever expect. For instance, terrorism, natural disaster, and political strife. Keeping these sobering realities top of mind, prudent investors don't chase hot asset classes. They stay true to a long-term investment plan in good as well as bad times. In the months ahead, that may not always be so easy to remember because the economic outlook has not looked so bright in decades. With a Republican majority controlling both chambers of the U.S. Congress and President-elect Donald J. Trump in the White House, corporate tax rates are almost sure to be reduced as part of sweeping new tax legislation expected to be enacted. And events in Washington are being felt on Wall Street. Just this past week, independent economist Ed Yardeni began factoring a corporate tax cut into forecasts for earnings on the S&P 500 index. Instead of the average company in the S&P 500 index earning $132 a share for 2017, he revised his earnings forecast to $142 per share. The average company in the S&P 500 index currently sells for about 19 times its trailing earnings for 2016. Applying a more conservative multiple of 18 to a hypothetical $142 of earnings for 2017 would put the S&P 500 index on track to hit 2556 at year-end 2017, 12% higher than its January 6th closing price. That's an unexpected surprise, and it could help unleash animal spirits rarely seen in the economy. In 1936, John Maynard Keynes, perhaps the most influential economist of the last century, coined the phrase "animal spirits" to describe instincts that drive people's decisions on matters of economics. A corporate tax cut is the kind of unexpected boost to the economy that unleashes animal spirits. When animal instincts are unleashed, data consistently surprises markets on the upside. And lately, that's exactly what's been happening. The surge since mid-2016 in the Citigroup Economic Surprise Index is statistical confirmation of this trend, and a stream of better-than-expected reports last week indicated strong economic growth is ahead. The Labor Department's new monthly report showed average hourly earnings rose by 2.9% last year, the best annual performance since this economic expansion began in mid-2009. Also this past week, a highly encouraging report from the Institute for Supply Management was released. To gather the data for this report, ISM conducts monthly surveys of purchasing managers at large companies outside of the manufacturing sector, which accounts for the vast majority of total U.S. economic activity. A reading of more than 50 in this index indicates the economy is expanding, and a reading of less than 50 indicates contraction. December's 57.2 reading is strong. What's more, a key forward-looking factor in this index, newly placed orders, surged last month to 61.6, as high as it's been in years. However, just because an economic expansion is underway doesn't mean you can't have a bear market. While recessions are a precursor to bear markets throughout modern U.S. economic history, stock price plunges of 10 or even 20% have occurred during economic expansions. At 91 months, this economic expansion is over 2 years away from lasting longer than the 120-month expansion of the 1990s, the longest in modern U.S. history. It could keep going. Because of the economic destruction wrought by the Great Recession, This recovery has been stretched out with nearly dormant inflation. A reduction in corporate taxes would accelerate growth. Stocks have been in all-time high territory and could go much higher. While the bull run is backed by economic fundamentals, investors could change their minds fast, particularly if something unexpected happens. While evidence of new global expansion is growing, political, social, and other types of turmoil are always possible. Barring that kind of unexpected bad event, we may hear Ethel Merman singing a lot in the months ahead. Stock prices are hitting new highs at the same time concerns are growing over fake news. We are an independent financial news source, uninfluenced by big media, Wall Street, or politics. Our weekly reports offer prudent analysis of news affecting your wealth over the long run. Feel free to share them with your family and friends.